Most aggressive bull case is probably, you're looking at like 10,000 on gold. I would say that would be a dream come true for me that holds a fair amount of the metal as a long-term investment. And I do think, again, if you look at the scenario where we're now as a country spending $1 trillion just on financing the debt, the interest on the debt, I mean, this is really setting up for what I fear is the 100-year cycle, which would match up with the Great Depression. And again, by no means do I want to scare people by using that term, and it's not on the horizon. Money can grow on trees, essentially, and the Fed can always save the day. And there's something called a 100-year cycle, and we're just nearing that 1929-1930 period that would be that 100-year cycle for the Great Depression. And I think gold would be the main avenue, and Bitcoin to some extent.
Gold's latest breakout wasn't luck, it was textbook. Gareth Soloway, chief market strategist at verifiedinvesting.com, points out that the metal traced one of the cleanest cup and handle setups you'll ever see. The breakout above $3,500 wasn't just a line on a chart, it marked the inflation-adjusted all-time high, a level etched into market memory. Once price cleared that zone, momentum followed. After testing in April, gold spent months consolidating in a steady base. That base finally gave way to the upside, but Soloway notes the chart is now flashing a topping tail. In technical terms, that usually hints at a short-term breather. Nothing alarming, healthy markets inhale and exhale. The number to watch is $3,500. What was once resistance has flipped to support, and if price dips back, that's where buyers are likely to defend. On the upside, Soloway's near-term target is around $3,800 into year-end, with parallel channel resistance defining the move. Beyond that, the conversation changes. Over the long run, he sees gold well north of $5,000, with the extreme bull case touching $10,000 if debt loads, relentless money printing, and crumbling faith in fiat accelerate. The macro story backs it up. Governments can't stop spending, the Fed always steps in with liquidity, and central banks from China to Poland are steadily diversifying reserves into gold. That's not a short-term trade, it's a generational realignment. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
The chart had this beautiful cup and handle pattern. It was just one of the best technical pattern setups. But looking at gold now, if we go to the chart here, what we can clearly see is that gold has had this big breakout above 3,500, which is what you mentioned was the inflation-adjusted all-time high. And I think that's amazing to think about, that the market doesn't necessarily, subconsciously it knows what that level was. And we went right there back in April, and then we went into this what's called long base of consolidation. And then what we've seen is a breakout above it. Now, there's two separate ways to look at this. In the short term, gold has put in what we call a topping tail, which means we should be due for a small pullback, which, by the way, small pullbacks are natural occurrences within markets. It's actually healthy for a chart to pull back, or a commodity in this case to pull back. So this topping tail signals that we'll probably retrace. What is the downside retrace where I would start buying again? At 3,500. Former resistance becomes technical support when you break out and retrace. And let's be clear, we're likely going quite a bit higher on gold from here. And the fact is it's just the basis of the government is going to continue to spend. The Fed is continue to do what they've loved doing for ages at this point, which is printing money essentially and flooding the system in any downturns. And that is going to fuel gold higher, and likely, in all fairness, probably down the line Bitcoin as well. 3,500 right now is the line in the sand that I'm watching, but there is always a chance when you've had something like gold run up as much as it has, you could go a little bit lower. But I will tell you this, there's a beautiful downsloping line and upsloping trend line here. It basically, at this point, I have a hard time believing gold would pull back lower than, let's say, 3,400 to 3,300. There's just way too much support now in this chart, in this zone, that as long as it holds there, you're buying it, at that pullback level. And that's exactly what I plan to do. So again, yes, in the near term, I'm a little like, again, if you say, well, where do you see gold in the next 2 weeks? I think gold comes down. I think it pulls back, natural occurrence. But if you ask me in 6 months, is gold higher? I do think gold is higher. Now, a lot of people are always asking, okay, well, what's your upside cycle target? Well, where could this go in the interim for upside? And I think to do that, what you do is you use what we like to do in the technical world, is you use essentially a parallel channel, right? And we start to look at parallels here. And I would say by end of this year, I would not be shocked to see 3,800. Now, that's not the cycle top, but I think 3,800 is likely your upside parallel trend line of resistance. So I think by year end, 3,800. And then I think you're talking in the next couple years well over 5,000. I think Goldman is pretty much dead on at this point. I love what you mentioned about, these countries. Poland just announced again 30% of their treasury is going to be gold. I think the important thing is that we're slowly seeing this de-dollarization. And again, when people talk de-dollarization, especially in the crypto markets, they're like, oh, it's going to happen overnight. Reserve currencies, if you look historically, that never happens. It's a longer process, but we're seeing the writing on the wall. China just continues to buy gold. Poland now is going to do a portion. And essentially what they're telling you is that they don't feel comfortable with the power that the U.S. wields because they have to rely so much on the dollar. And so they're slowly diversifying away, which will slowly weaken the dollar over time. And in fact, the dollar chart is telling us exactly that. In fact, I want to go over this chart because the DXY chart is really, really telling. So if we go to the dollar chart here, what we've seen is a key breakdown in the US dollar here, and I'm going to just draw this in for you guys. So there was this trend line zone that was holding on the US dollar for the last basically 2 to 3 years. And you can see again, going back to 2022, we would hit, and every time we hit, we would bounce on the dollar. All of a sudden, we broke below. Now it becomes resistance. Remember, support, once support breaks, it becomes resistance. And now up it goes, rejected. Up it goes, rejected. Now the concern I have here on the US dollar is if we flip to a longer time frame and we go back to 2008. And by the way, 2008 is not an arbitrary date. It is when the financial crisis started. And so if we take a trend line from there and we drag it up, the dollar has a very distinctive trend line that basically goes from 2008 all the way to the current lows. My point being, if the dollar breaks this level around 96 to 95, that would be a major technical chart breakdown. And I would say, listen, again, I want to be clear. It doesn't mean it's going to collapse overnight, but I would actually think the dollar would head within the next, let's say, 5 years down to 70 on the DXY. And 70, I mean, that would be shocking to see for all of us. I think the big macro signal is this, right, is you have two scenarios. So number one, the stock market and gold have been making new all-time highs consistently together. That does not last. If you look historically, it can last for short periods of time, but it's telling you one of them is not going to last. And in this case, I believe gold, while it might have small pullbacks, gold is going to be the one that is going to outlast, whether it's weakness in the dollar, whether it's the labor market and people running for the safety, whether it's global central banks that continue to buy gold, or these countries that are going to continue to buy gold. Gold is becoming that place to go, along with Bitcoin to a much lesser extent, where money is flowing. And again, if that's going in that direction, that's not good for the stock market overall. So that's a big one that I'm following. And again, keep this in mind. Watch for a break of trend from either gold or the dollar, gold or the market. And I do think the stock market will give way as the data continues to weaken here. As a technician of the charts, you always want to look at both sides of a trade, right? Because you can believe you're going to be right in one direction, but if it goes against you, how do you maneuver? And so the bear case on gold is probably a retrace to 3,000. 3,000 would be unbelievably important for it to hold. It's that key psychological number. You don't want to see, if you're a gold bug, if you love gold, if you're invested in gold, you don't want to see a two handle at the beginning of gold. So 3,000 right now, again, that 3,400 is where I'm thinking it'll pull back. If it breaks that, you could see 3,000. That must hold, and I do believe that, again, for me, anything below 3,500, I'm going to start buying gold actively all the way down to 3,000. If it breaks 3,000, I'm going to get a little bit concerned, though. Let's be fair.
And most aggressive bull case?
Most aggressive bull case is probably, you're looking at like 10,000 on gold. I would say that would be a dream come true for me that holds a fair amount of the metal as a long-term investment. And I do think, again, if you look at the scenario where we're now as a country spending $1 trillion just on financing the debt, the interest on the debt, I mean, this is really setting up for what I fear is the 100-year cycle, which would match up with the Great Depression. And again, by no means do I want to scare people by using that term, and it's not on the horizon. But I do think they always say, and this was something I grew up with. My grandmother went through the Great Depression. She taught me a lot. But every generation is supposed to experience something like that. And we've gotten away from it. People think it's just easy times and money can grow on trees, essentially, and the Fed can always save the day. And there's something called a 100-year cycle, and we're just nearing that 1929-1930 period that would be that 100-year cycle for the Great Depression. And I think gold would be the main avenue, and Bitcoin to some extent. Yeah, charts are looking good on silver. I continue to like silver here. You can see you had this beautiful wedge pattern right here, and again, this wedge pattern. Look at this trend line, how every time going back to 2023, every time it hit, it pulled back, and then pulled back recently in 2025 twice, and then what it does is it gaps above. It's like, okay, I can't walk through this river because the rushing river will take me away. So let me hop over. Let me take the bridge over. And all of a sudden it breaks out, consolidates. This is a bull flag, and it's beginning to move higher. So this is a breakout on silver. And silver we know has lagged gold. I do think it's in the process of playing catch up. Basically, I'm expecting it to have a small stop at $44 per ounce, but really likely headed to about 48 to 50, which would then, if we go to the bigger time frame, 48 to 50, where does that take us? Back to this high here, 1980 and the 2011 highs. Essentially, that would be called a triple top, and that would be expected to be resistance.
So what level would that be at there?
Yeah, so you basically look to sell it to $48 to $50. So if silver gets to 48 to 50, I would expect it to pull back. Now, it could eventually break out, and that's what I would start to watch. And let me just do a quick teaching on this. So if you have silver, right, and silver, let's say, rips up to 48 to 50. Let me get my drawing tool out here. So let's say we rally up here. You then watch, as a technician, you watch to see what it does off of this level. What you want it to do is basically go sideways to lower, which creates a bull flag. It's essentially digesting. Think of a marathon runner who just ran a marathon. They're exhausted. You can't be like, go run another marathon. They're going to be like, no way. I need to refuel. I need to sleep. I need to rest. I need to eat. This is what this is. It's consolidating. It's refueling. And then you get your big move up. What you don't want to see is you don't want to see a sharp reversal. A sharp reversal would be bearish. So as a technician, if let's say we get to $48 to $50 an ounce on silver, I will then begin watching what price does around that level, and that will give me insight into the next likely move. Silver is going to be seen as obviously the macro, driver of combustion engines, which are now becoming more and more popular again after the EV kind of had its phase. And I still think EVs are in that direction, and they will continue to grow, but not nearly as much as people thought. And so I think you have that aspect to it. But I also think that you're looking at there's these sovereign funds in these countries that are saying, okay, gold has had this massive run, and just like the dollar, we don't want to just be in one metal. Like, what if something happens and there's a massive find of gold? Let's diversify. And I think, again, what's so interesting here is that these countries are learning from their mistake with accepting the dollar as the major reserve currency, where it gives the U.S. way too much power. They're not comfortable with that. And now they're saying, okay, listen, gold is great, but now let's also have a little of X, Y, and Z metals in our portfolio. And I think that's a great thing. I mean, it's the equivalent of having Bitcoin, but having some Ethereum in your portfolio. Same sort of thing, or Apple and Microsoft and Google, right? We just don't go all in on one thing. And they learned from what they've done with the dollar and the power that the U.S. wielded.
Markets are betting big on rate cuts, but Gareth Soloway warns the setup isn't as bullish as it looks. Fed funds futures are now pointing to 3 cuts by year-end, one at each of the next meetings. Last week's jump in jobless claims to 263,000 even had traders speculating on a jumbo 50 basis point cut. But the bigger backdrop is stagflation. Growth is slowing, the labor market is cracking, and headline CPI is still running near 4%. That combination leaves the Fed in a trap. Soloway expects Powell to deliver a 25 basis point cut next week, but don't mistake that for dovishness. The Fed chair is likely to emphasize that inflation remains sticky, which could cool some of Wall Street's optimism about a rapid easing cycle. In other words, cuts are coming, but not on the terms markets might want. Meanwhile, institutions are already positioning for stress. Late Friday, Soloway spotted heavy buying in the VIX, the volatility index. That's unusual because the VIX sat near historically low levels. It's a classic signal that smart money is hedging against turbulence before it shows up in equities. The risk, he says, is that the narrative flips. What starts as excitement about cheap money can quickly morph into recession fears, falling growth, weaker profits, shrinking valuations, and ultimately lower stock prices. Let's get back to the interview.
I'm not saying that there's nothing done deliberately out there, because there certainly is, but one of the things that drives me nuts is that the government sends out these surveys to companies, and they say, hey, could you please let us know, are you hiring, are you firing, are you doing nothing? And there's a tendency, if a company is hiring, they're quickly like, oh yes, this is good news, let me fill it out that we're hiring and send it back in. But if they're not, if they're firing, no one wants to write that in. Like, yeah, I had to fire 5 employees today, or whatever it may be. And so because the government doesn't make it mandatory that there's a receipt of this data back to them by a certain date, there tends to be a lag on receiving this data, right? It's kind of like goes on the pile, and the CEO says, oh, I'll do it when I have time. It's not great news. And I think that's one of the big problems. And it drives me nuts. If you and I get something from the IRS, they say respond by this date, and we all know, if not, you're in trouble. With this type of stuff, there's no penalty. So a company can just take their merry old time, yet the Fed is literally basing their decisions on federal interest rates on this data, right? We're all trading. Like, as a trader, I am trading on this data. It needs to be accurate. The government needs to put a direct receipt date on it, like get this information back by X date, or there will be a fine. And I know that sounds crazy and kind of maybe a little ruthless, but when you have trillions of dollars being traded on this information, you have to have it accurate. Yeah, so I'm going with what the Fed Watch tool is saying right now. I think 3 rate cuts into year end, 1 at every meeting. I know after the last jobless claims shot up sizably to 263,000, which was dramatically higher than anyone expected, the markets kind of rallied on hopes of a 50 basis point. But this is the tricky thing. We are now in an official stagflation environment. And really, most media is not going to announce that, folks. But the definition is slower growth. And in this case, the labor market is slowing dramatically, and higher inflation. And we saw the CPI this week coming in at 0.4% on the headline, and just map that out, multiply it by 12. If that stays at 0.4 every month, we are basically at 4% inflation, if not even a little bit higher. And so that's the definition of stagflation, and that puts the Fed in a ridiculous bind. So yes, they will give you a rate cut coming next week, 25 basis points, probably 1 at every meeting. But the markets, in my opinion, have already priced that in. And my thing is this: I think we sell off next week. And by the way, late in the day on Friday, we saw some big accumulation in the VIX. The VIX is the fear index. It's basically below, or was below, 15, very historically low. And when I see that, it is a warning sign that institutions are starting to buy protection for expected volatility. And so ultimately, my expectation is a very hawkish Jerome Powell. Yes, he'll do the cut, but he's going to talk about how inflation is still an issue, and it's going to make the market rethink how many cuts next year they're going to get. I don't have a chart on that, but folks, I have seen these charts every which way, and we can definitely put one in for you. But the key is this, is that if you look historically, markets rally on rate cut expectations, the excitement of cheap money. But once the Fed starts cutting rates, historically, the markets actually go down. And the reason they go down is very simple. By the time the Fed actually starts to cut, the market is fretting that they are behind the curve once again, like the Fed usually is, and they need to cut more. But the Fed is very slow on cutting, and we're seeing that with the inflation numbers. The Fed will likely just cut 1 time at every meeting into year end. And so the market then starts to price in that things are a lot worse than expected, and that we're heading towards a recession. A recession means lower profits and profit growth for companies, and PE ratios start to adjust. So be ready for that in this scenario. And remember, technicians like myself, we don't reinvent the wheel. We look at historically what happens every time, and if it happens every time, who are we to think this time will be different? A lot of investors out there will tell you, oh, this time's different. I heard that in 1999 too, and then we saw 85% drops in many of the big name tech stocks then as well. So I think the markets will start to see a top being put in here over the next week or weeks. I think it's going to be a choppy period because, again, we've lured investors into believing that every dip, even 1, 2, 3% dips, are buying opportunities. But as that gets dissipated, as the investor starts to run out of investable income, that will then start to slide further and further south to the point where I do think you're looking at a 20-30% correction into next year once again. And the difference here is everyone will expect it to rebound like after the Liberation Day sell-off, after the COVID sell-off, after even last in 2024, that August nasty sell-off, we came back to all-time highs. I don't believe that is going to happen. And I think, honestly, the market and maybe Fed officials and maybe government officials have done a big disservice to investors by luring them in. Since COVID, millions of new young investors have come into the market, and they now believe that the biggest correction they'll see, yeah, they might see down 20-30%, but within 3 months, we're at all-time highs. That is not always the way. In fact, if you look back at 2000, when the NASDAQ collapsed, 15 years it took for it to hit a new all-time high. Because the markets trade on psychology, right? So you have the human psychology of, oh, it's a 3% pullback, let's buy the dip. Okay, so then you get a 2% bounce, right? Then you get a 5% pullback, buy the dip, you get a 3% bounce. And so initially when markets top, they tend to top with a lot of chop with a slight downward angle. And then eventually people start to say, wait a minute, I keep buying the dip, and then it keeps making lower lows. And then they stop buying the dip, which is when the downside accelerates, and that's usually the bigger move. So initially, especially the way the markets have been conditioned, you'll see sideways to slightly lower chop, then the downside comes in probably in early 2026. We are in extreme greed to the point where, I mean, when you see Oracle, and I'm going to show you guys a few charts here that just kind of blow my mind here. So let's look at Oracle, ORCL, 40%, actually it was up as much as 40% on earnings. This company was valued at $700 billion before earnings were, it basically plummeted back down here. But when you see these type of moves where a company can gain that much, and again, by the way, you have to go back to the 90s, by the way, pre.com, the last time Oracle had a move of this magnitude. And that's very telling to me is when you start to repeat history, it makes me on high alert. But we see that Oracle's obviously coming back in. But then you have other stocks like QMMM. This stock in one day ran 2,700%. Now, all this company did was say, hey, we're going to put some crypto in our treasury, and investors rallied it 2,700% in one day. And again, you could go to many other names. Octo was another one this week. Octo rallied 5,600% in one day. And again, for those of you that have traded crypto, remember in 2020, 2021, or even prior to that, where altcoins were doing this type of massive move, and then the collapse occurred. And this, to me, is a sign of that kind of gambler's mentality that is so concerning in our markets right now. And again, just a couple other charts that I'd love to show you guys here, because I do think this brings a kind of a more grounding perspective. And one of the things I talk to everyone about is just look for the breadcrumbs. And the breadcrumbs, while it doesn't tell you like on this specific date the markets will top, it gives you enough data to make smart decisions, right? And you might feel like, oh, I missed the run up, or I missed, the last leg. But you know what? Protecting, at least for me, protecting my money is the most important thing. This is the S&P price to sales ratio. We are now at over 2 standard deviations away from the average, historical average. And by the way, we are more than in 2020, and that is astounding. Then we flip over to this chart. Here's the S&P 10-year PE ratio. 2 standard deviations above. Granted, not at the internet bubble high, but incredible how overbought we are in that metric. And then lastly, this one, guys. This is the Buffett indicator, right? So we all have heard about Warren Buffett. Buffett indicator is the ratio of total value of the U.S. stock market versus the current measure of total GDP. And look, we are now at all-time highs on this metrics. You can go back to the .com level, we're above that. You can go back to the 1970s, we are above that as well, right up there. And basically, I mean, just to summarize, when you're 2 standard deviations above something, It doesn't tell you, again, this date, we're going to reverse this second. What it tells you is you better be freaking on point, because at some point the music is going to stop and the rug is going to get pulled. And the higher you get, usually the harder you fall.
Momentum in gold and the shifting tide in monetary policy are weaving together into a story that feels less about short-term price moves and more about structural change. Soloway's charts highlight the precision of technical patterns, but beneath those lines is a deeper current. Trust in fiat continues to erode while demand for tangible stores of value builds. At the same time, the Federal Reserve faces a narrowing lane cut too aggressively and inflationary pressures resurface, hesitate too long and growth stalls further. Both scenarios funnel investors toward assets outside the dollar system, with gold positioned as both shield and signal. What stands out is not just the upside targets or the number of cuts expected, but the convergence of psychology, policy, and positioning that can turn small shifts into cascading moves across markets. So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.